Why I'm not panicking on the stock market. So there's a lot of factors involved. I mean, the economy is kind of complex because there's different factors that affect different things. I mean, there's stimulus, there's interest rates, there's bonds, there's different aspects of the equity market, there's buybacks. There's quite a few factors. There's jobs reports, economic data, and others. So it's trying to make sense of it. But I think there's a few fundamental factors I want to go into in terms of why I'm not panicking on the stock market, even though a lot of the tech stocks are down 30 to 50%. Some are down 60%, which is a major, major correction, obviously. Some people consider it buying opportunity. Some people consider it, time to get out. What is market psychology? That, money always flows to where it's best treated, just like people. And best treating money is being, the most informed, having the best informational systems. That's why I invest almost all my time and energy, apart from operations and execution, into learning and knowledge and information systems. Like, I have the best information pumped into me every day by the systems that I've created. So I think that gives a little bit of an advantage. I mean, there's no guarantee that even if you have really great information that you're going to be able to act on it appropriately, but it gives you a big leg up. And the other thing is the psychology. Like you heard Warren Buffett say, be fearful when others are greedy and greedy when others are fearful. What happens is that's just kind of like the baseline, that there's other, layers to it. But basically there's different, I think, patterns that develop, and not just one pattern that always repeats, but a series of patterns. Like Ray Dalio talks about this a little bit when he talks about like the different, cycles, both in terms of currencies and debt cycles, short-term debt cycles and long-term. Once you start understanding pattern and pattern recognition, that's why algorithms are so successful. If they're well done, because they understand patterns. Algorithms not only in the stock market, but in anything. Buying behavior, e-commerce, or algorithms on loans and default rates and things like that. Once you understand the patterns, and it can be garbage in, garbage out, and a lot of times, things don't account for black swans and other kinds of things. But, by and large, the better pattern recognition that you have, that's why as human beings, like, we don't step in front of cars because, we recognize, a car is dangerous. I mean, we don't put our hand in fire, because we realize that's dangerous. I mean, we've pattern recognition, we don't stand in front of a lion. Certain things we just innately, by our evolution, recognize are dangerous, and certain things we recognize are dangerous, by our experience, certain kinds of toxic people or, certain kinds of situations. So psychology plays a big part of it. Another reason why I don't think the stock market's going to take, but as I always say, this is just my opinion for informational purposes only. This is not investment advice. You have to do your own research, your own thinking, and come to your own conclusions. So I'm not a financial advisor by any means. But what I believe for myself is that a couple other factors, like there's a few people that I kind of like trust their judgment. It doesn't mean they're always right, but I see what they say, and there's probably like 50 people that I look at, so it doesn't get weighted just across one person. One person is Kathy Wood, one person is Elon Musk, one person is Shamath Palihapitiya, and there's quite a few others. These people have a track record of being right to the outsized degree, much, much more than they're wrong. And so I listen to what they say, but I factor it in terms of my own thinking also. So one thing that Kathy Wood said recently is that the yields on the bonds are not going to break the stock market, because we actually have been in a bond bubble, and there's a lot of bearishness in the bond sentiment, still that the bonds are not going to keep going up and up and up. I mean, they've been going up, but Kathy Wood, for that reason, because she feels that we've had a bond bubble, and there's some, charts on that, and there's a lot of bearish sentiment. Like, there's a huge amount of shorting in the bond market. So when there's a lot of shorting, that prevents the bond rates from rising, because there's so much negative, sentiments, negative dollars against it. So if the bond yields can't keep on rising too much, then that will allow the stock market to do better because if bond yields go up and up and up, then people take their money out of stocks and put it into bonds to get higher, chasing yield. Another factor is that we have so much stimulus in the economy, and this is resulted in not only more people having jobs now. I mean, jobs are down from when the pandemic started, obviously, but they're way up from what they were, months ago. So more people have income, disposable income. Kathy Wood also said that the charts show that the savings rate is like up to 20%. It was down to like 10%. So people have more money in their pockets. The other reason why I think the stock market is for real is because a lot of people, like the retail investors, like the Wall Street bets, these people are like now hinging their future on stock market, gains, and also partly getting into crypto. So people are getting into NFTs. I'm not saying the stock market is the only game in town, but there's a lot of people that have really like stock market trading has gone more mainstream now. They say that like when your barber gets into the market, when your barber starts giving you stock tips, that's when it's time to get out of the market because then it shows that it's too frothy. So that could be an argument in either direction. That more people are into it could be, a signal that more people believe in it and are in it for the long term. Even through the dips, or it could be a signal that people are just in it for the short term. But it seems to me that a lot of these people that have gotten into it, some are like in it for the short term. I think a certain percentage, and I don't know exactly what that percentage is, but I think it's a healthy percentage, are in it for the long term. I think that like just the level of analysis and sophistication of what they're doing shows that they're not just in it for a week, a day, or a month. So when you put those factors together, there's other factors as well. That's why I'm not panicking in the stock market.